How to truly assess your investment portfolio performance. Imagine trying to judge a race without knowing the starting point or the finish line. That's what assessing your investment portfolio without proper analysis is like. To truly understand how well your investments are doing, you need to look at more than just the numbers. It's about measuring both the returns and the risks involved, then comparing these results to a standard or benchmark. Start by figuring out your portfolio's return, which is simply the total gain or loss over a specific period. You can look at the absolute return, which is the percentage increase or decrease in your investments, or compare your performance to a benchmark, like the S&P 500 index if you mainly invest in large U.S. stocks. Benchmarks act as a yardstick, helping you see if your investments are doing better or worse than the market segment you're targeting. Next, consider risk-adjusted performance measures. These tell you if higher returns are because of taking more risks or because of good decision-making. The Sharpe Ratio is a popular measure that calculates how much extra return you earned for each unit of total risk you took on. A higher Sharpe Ratio means you're getting more reward for the risk you're accepting. The Treynor Measure looks at systematic risk, which is the risk related to overall market movements, and Jensen's alpha shows if your portfolio outperformed what was expected based on its risk level. The M-squared measure converts the Sharpe Ratio into a percentage return, making it easier to interpret. Performance attribution is another key step. It breaks down what parts of your returns came from different decisions. For example, how much of your gains came from choosing certain asset classes like stocks or bonds? How much was due to selecting specific securities within those classes? And how did your combined decisions impact overall performance? Understanding this helps you see what is adding value and what might need adjustment. It's also helpful to analyze your portfolio's exposure to different market factors. For example, how sensitive is your portfolio to market swings? Do you have more exposure to large or small companies? Are you leaning more toward value stocks or growth stocks? Knowing these factors helps explain why your portfolio performed the way it did. When calculating your returns, pick the method that fits your situation. Time-weighted return is best if you want to remove the effect of deposits or withdrawals and compare different strategies. Money-weighted return, or internal rate of return, considers the timing and size of your cash flows, giving a picture of your personal investment experience. Don't forget to factor in fees, taxes, and inflation to see your real return. While these are often excluded when comparing to benchmarks, they are important for understanding your actual gains. To keep your investments on track, regularly review your performance. Choose a relevant benchmark that matches your goals and asset mix. Calculate both absolute and relative returns over consistent periods. Use risk-adjusted measures like the Sharpe Ratio to see if your returns justify the risks taken. Break down your performance with attribution analysis to understand what is working well. Keep an eye on your factor exposures to see how market conditions are affecting your investments. And always select the return calculation method that best reflects your cash flow patterns. By following these steps, you'll get a clear picture of how your portfolio is performing. This knowledge helps you make smarter decisions, adjust your strategy if needed, and stay aligned with your financial goals.